For most investors, when they start talking about diversification, what they're really looking for is protection from the stock market during a crash. I've been in the wealth management industry for over 25 years. I've met with over 300 wealthy families throughout my career. And in my experience, nearly all of the wealthy families that I've met with, when they start talking about diversification, what they really mean is that they want protection in the event that the S&P 500 has a crash. I thought it would be fun to make a video exploring real estate funds and individual REITs as a source of downside protection if the stock market were to crash. What kind of diversification benefits can we expect from investing in real estate funds, ETFs, and individual REITs? For our analysis, we're going to look at a number of the largest real estate ETFs. We're going to look at the diversification benefits they provide and how did they perform during the 2020 and 2008 market drops. In addition to the ETFs, we're also going to look at 6 of the largest individual REITs from industries such as multifamily, healthcare, industrial, data center, etc. We're going to analyze what diversification benefit did these individual REITs provide in the past and how did they hold up when the market dropped in 2008 and 2020? What type of diversification benefit did they give us? What kind of downside protection did we get from these individual REITs? I think you're going to be very surprised by the results. I know I was. The difference between real estate ETFs and the amount of diversification benefit they provide versus individual REITs is fairly significant. So you'll want to stick with me for the whole video. We'll begin our analysis with 5 of the largest real estate ETFs and see how they held up during the 2020 market panic. Vanguard Real Estate Index Fund, VNQ. iShares Cohen & Steers REIT, ICF. Spider Dow Jones REIT, RWR. iShares Core US REIT, USRT. And iShares US Real Estate, IYR. I've also included the S&P 500 total return, and all of these REIT ETFs are also on total return. If we started with $100,000 investment in each of these REITs in the S&P 500, which is the pink line, and chart it for total return, here's where we end up a year later. We're starting the investment on 12/31/2019, ending on 12/31/2020. You can see that when the crash came, the REITs moved in unison with the S&P 500. Everything is channeling together, no downside protection. In fact, some of these REITs did worse than the S&P 500. And then the REITs did not participate in the rebound as strongly as the S&P 500. You can see the S&P 500 finished the year positive. The REITs finished the year negative. Here are the same real estate ETFs, total return against the S&P 500 for the period December 31, 2007 to December 31, 2009. S&P 500 is the pink line. Here are the REITs. They were performing better than the S&P 500 early on. The crash comes, everything drops. The REITs drop in unison again. Notice how tight they're moving together. And then they bottom out worse than the S&P 500. Peak to trough, the S&P 500 was down about 56%, but the REITs were down over 60%. Then the rebound comes, and you notice the REITs are moving back up, and they end at about the same dollar value as the S&P 500. We're graphing out $100,000 initial investment in all these different REITs and the S&P 500. No downside protection from the REIT ETFs during the 2008 market crash since they are moving in unison with the S&P 500. No diversification benefit. In the last 3 years, the same real estate ETFs that we've been looking at have been very highly correlated, row 6, to the S&P 500. How you interpret this chart is you look at the intersection between the column on the left-hand side and the staircase. For instance, if we look at the intersection of 2, which is the iShares US Real Estate ETF, IYR, and 6, which is the S&P 500, we're at 0.86. So you see these numbers, 0.86, 0.86, 0.87, 0.87, and 0.85. all very high positive correlations to the S&P 500 for these 5 REIT ETFs. There are 2 important conclusions that we can draw from this information. 1, in the last 3 years, REITs have been very highly correlated to the S&P 500 and have provided a minimal diversification benefit. In addition to that, in the last 2 major market drops, 2020 and 2008, REITs did not provide any downside protection. They moved with the S&P 500, and in both cases, and I'm talking about REIT ETFs, let me clarify, these REIT ETFs dropped significantly and oftentimes worse than the index. And in the 2020 drop, the REITs did not come back as strongly as the S&P 500. So if we add that all up, REIT ETFs have been a limited diversification benefit for a long time. If you have questions on your diversification strategy, please give my office a call. We would be happy to give you a second opinion on your investments. Now let's take a look at some individual REITs. You're going to see very different results. If you had experienced the 2020 market panic with individual REITs, you may have done worse or better than the S&P 500. We're looking at Prologis, an industrial REIT, American Tower Corp, a cell tower REIT, Welltower, a healthcare REIT, Digital Realty Trust, a data center REIT, Simon Property Group, retail, and Avalon Bay Communities, multifamily. All of these REITs and the S&P 500, which is pink line, have been charted for total return. And you can see that the data center REIT, Digital Realty, did fairly well when the crash occurred, even rebounding above all of these other investments relatively quickly and ending higher than the S&P 500 at the end of the year. The purple line, Prologis, the industrial REIT, did about the same as the S&P 500, and then a few of these did much worse than the S&P 500. Simon Property Group, for instance, finished at $61,000 and change. All of these have been charted for a $100,000 investment at the start of the year. So depending on which individual REIT you owned in 2020 and what sector that REIT was operating in, you may or may not have received some downside protection and a diversification benefit. Here's the 2008 crash with the same individual REITs. We're looking at the period December 3107 to December 3109. Interesting that 5 of the individual REITs finished better than the S&P 500. S&P 500 is the pink line. We're starting the period with a $100,000 investment in all of these REITs in the S&P 500. Once again, total return. And we're ending for the S&P 500 with $79,000. But look at the data center REIT. It finished at $140. And Welltower, the healthcare REIT, finished at $113. Only one REIT underperformed the S&P 500 during this time period. That was Prologis, the industrial REIT, got hit pretty hard. Also notice that when the crash started, the REITs start dropping. The industrial REIT really falls off a cliff. But then when the S&P 500 is bottoming out right here, you can see that several of the REITs were much higher in price, giving you some downside protection, some diversification benefit, and then finishing stronger. In the last 3 years, some of these individual REITs have lower correlation to the S&P 500 than what we saw with the REIT ETFs. For example, American Tower Corp, cell tower REIT, is at 0.63 against the S&P 500, 0.63 correlation coefficient. Or number 3, Welltower is at 0.64 correlation coefficient to the S&P 500. That's what we would call moderate correlation. 2 of these REITs, Prologis and Simon Property Group, have strong positive correlations to the S&P 500. But overall, we're seeing much better correlation coefficients with the S&P 500 on these individual REITs, indicating that you get more of a diversification benefit in the individual REITs than you do with the REIT ETFs. The one thing that you have to remember with the individual REITs, however, is that while they may offer a better or lower correlation to the S&P 500 and potentially better downside protection in a crash, they do come with individual security risk. The indexes or the large REIT ETFs do not have security-specific risk. But when you buy an individual REIT, you could potentially lose all your money if the company went bankrupt. So always remember that individual securities have a unique risk that the ETFs do not. If we extend the holding period to 10 years, the correlation matrix for the individual REITs is much more encouraging. You can see that line 7, which is the S&P 500, has all moderate correlation coefficients, and one of them is only 0.36. That is the data center REIT Digital Realty Trust. But if we look at the 10-year correlation matrix data for the REIT ETFs, we don't see near the amount of diversification benefit. If we look at row number 6, the S&P 500, we see very high degree of correlation for the REIT ETFs. There is some diversification benefit here because we're in the 0.7s, but it's not a lot. So let's add it all up. In the last 17 years, REIT ETFs do not appear to have given you much downside protection or diversification benefit. They were moving up when the S&P 500 was going up and down when the S&P 500 was going down for the most part. Individual REITs, however, are a different story. If you picked the right REIT, if you were in the right sector, you may have received a healthy amount of both diversification benefit and downside protection, as we saw in the case of the data center REIT and the healthcare REIT at various times. Now, this video is not an endorsement for any of these ETFs or any of these REITs, and you can lose a lot of money, like we saw with Prologis during the 2008 crash or the REIT ETFs during the 2008 crash. They got smoked. So you'll want to check with your financial advisor before you invest in any of these, if you're even thinking about it. I just wanted to show how much diversification benefit we could potentially get with REIT ETFs or individual REITs. If you like this content, please share it with your friends. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.